Hey guys, this is Chris Elliott over at Remax Action. Today we're going to be talking about 5 simple graphics showing you that the Corona pandemic is not like 2008, and out of the video. All right, so this first graphic shows you the mortgage availability, credit availability index, which basically shows you the availability of mortgage credit and how, i.e., in layman's terms, how easy it is to get a mortgage loan. So as you can see in the run up to the housing bubble, very, very easy to get mortgage credit. We had ninja loans going on, which if you're not familiar, that was no income, no job, no assets. Essentially, you did not have to prove anything to get a loan. You could literally walk into a mortgage broker's office, tell them how much money you made or didn't make, them not even have to verify it with any type of documentation, and they would give you that loan. As you can imagine, when folks are able to get easy credit, that can potentially be a problem. We do not have that same problem today. Mortgage standards were made much more rigorous after the crash, and those standards have been held throughout up until today. So not that it's impossible to get a loan, but you do have to, bankers are making sure and verifying that you can actually afford the money that they're lending you. All right, so the second point is, while home appreciation has been very good over the last 6 years, it is nothing like and is well below the appreciation and the run-up on appreciation that we saw in the 6 years preceding the housing bubble. So as you can see in the graphic, much more appreciation during those times. Part of that was fueled by the availability of easy money. So anytime there's easy money being lent out, prices naturally go up because who cares? It's easy money anyway. Might as well pay the difference. Not unlike what you're seeing in college today. Third difference between now and 2008 or the housing crisis. So we do not have the surplus of inventory that we had in the run up to the housing crash. So in 2007, we were sitting at about 8 months supply of inventory, which is a good amount of inventory. We've been pretty steady in our Richmond market at anywhere between 2.5, and we're at a three month supply of inventory on a national level, meaning that it's much more of a seller's market, and there's still a much greater demand for housing. When there's a surplus of inventory, that causes prices to tumble, whereas when there's a shortage of inventory, homes certainly hold their value and they continue to appreciate due to the lack of supply and the increased demand. And hey, quick little prediction here. I could be wrong, but I would not be surprised if home prices appreciate through the Corona pandemic and they come out even higher when this is all said and done, because what we're starting to see a little bit is we're seeing some sellers pull their homes off the market, whereas the demand for these homes has not changed to the date of this video. Fourth difference, unlike the run up before the housing bubble, homes are much more affordable in today's day and age. In 2006, if you had a median income buying a median house, 25% of your daily paycheck, or your monthly paycheck rather, had to go to affording that median home. Whereas in today's day and age, only about 15% of your paycheck is required to own a medium home if you had a medium income. Part of that is with incomes rising, but also part of that is with mortgage rates being much lower than they were before. Therefore, housing is much more affordable because the debt is cheaper and the cost to carry that debt is a lot cheaper than it was before. All right, so the fifth and final reason that we are not headed into another 2008 is people are equity rich and not over leveraged. So if you look at the graphic, what part of the reason that we got ourselves into trouble in the housing crisis is people were using their homes as an ATM machine with the run up of appreciation and the loose banking standards, the loose lending standards. Folks were just pulling equity out of their homes and they were putting in depreciating assets, or they were buying more home than they could necessarily afford. Due to conservative lending and also in the run-up with appreciation that we have over the last few years, people have more equity than they ever had before. About 50% of households in America have 50% or more of equity. So as you can see, we're sitting on much, much more equity within our homes in these great United States of America right now. So guys, that was the 5 reasons that whatever we're heading into right now is not going to be another repeat of 2008. If you have any questions, concerns, reach out to me. Go ahead, hit the bell, like us, comment, follow, whatever you need to do. We look forward to seeing you on the next video. All right, so for you guys that stayed to the end, I appreciate you. I want to give you a quick little bonus material, something that I just read not too long ago. So Goldman Sachs, you know, the money guys that have much bigger research departments than you or I have access to, they just released their GDP forecast for the remainder of 2020. We are expected to see a hit in GDP in the second quarter of this year due to the pandemic. We're looking at about a 5% decrease in GDP, but as you can see, we're looking at increases in GDP for the second half of this year with, I quote, further strong gains in early 2021. So that is the light at the end of this tunnel. We'll all get through this together, and it looks pretty bright on the other side of it. So thank you guys for tuning in. We look forward to seeing you on the next video.